WCM's mission is to accelerate equity, diversity, and inclusion in the financial sector. We are hosting this event from what is now known as Toronto. So we would like to acknowledge we are meeting on the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, and the Haudenosaunee and Wendat peoples. We'd also like to recognize the enduring presence of Indigenous peoples on this land. Our virtual participants today are located across the country and on other Indigenous lands with applicable treaties or unceded territories. We also want to acknowledge the suffering and uncertainty felt by those affected by the Russian invasion of Ukraine, both those involved in the conflict directly, as well as those with loved ones in Ukraine. I was coming down the elevator this afternoon, or this morning, on my way to this venue, and I shared the elevator with 2 other people, which was fantastic. I'm very excited that we're all coming back in person and seeing people in elevators. It's great. And one of the individuals was speaking to his colleague and said, you know, it's the first time in my career that interest rates have been going up. And I thought, wow, how fitting. I'm on my way to a Bank of Canada event, and we're talking about interest rates already. I'm not an economist, but I did learn in one of my econ classes that one of the most important roles of a central bank is to set expectations for future monetary policy. I can't think of a more challenging and uncertain time for central banks globally. This room is filled with some of Canada's most active capital allocators. While we have our own opinions on how best to engineer a soft landing, the one thing that we can probably all agree on is that Canada's financial sector is one of the strongest in the world, measured by financial depth, access, efficiency, and stability. It is now my distinct pleasure to introduce Carolyn Rogers, Senior Deputy Governor of the Bank of Canada. This is the first public speech delivered by Carolyn as Senior Deputy Governor, and the first in-person speech by a Governing Council member since March 2020, as we talked earlier. Carolyn was appointed Senior Deputy Governor on December 15th, 2021, for a 7-year term. Carolyn served as Secretary General of the Basel Committee on Banking Supervision. From 2016 to 2019, Carolyn served as Assistant Superintendent, Regulation Sector at OSFI, where she was responsible for OSFI's policy-related functions, including capital accounting and legislation. Prior to joining OSFI from 2010 to 2016, Carolyn served as Superintendent and CEO of the Financial Institutions Commission in British Columbia. During this time, she also chaired the Canadian Council of Insurance Regulators and the Canadian Credit Union Prudential Supervisors Association. Carolyn worked in various roles in the private sector before embarking on her career in the public sector. These include roles at several credit union organizations, major banks, and as CEO and CFO of a private company. Senior Deputy Governor, we look forward to hearing your comments today. Thank you very much for being with us.
This fancy speech box they've given me. Okay, thanks, Lara. Thanks, Mary. I'm really thrilled to be giving my first speech at a Women in Capital Markets event. Your goal of accelerating equity and inclusion in the financial industry is one the Bank of Canada shares, and it's one that's near to my heart too. And thanks all of you for being here. I'm like Lara, I'm still a bit thrilled to get in a room with a bunch of other people. So it's great to have you here. Just a couple of shout outs before I get going. First, Lynn Patterson, one of the bank's former deputy governors, colleague of mine, mentor of mine, and I'm really glad that you're here today, Lynn. A former colleague of mine from OSFI, Romana Mizdrik, glad to have you here. Romy Bowers, joining us from CMHC, also a colleague and a friend. And we also have Claire Kennedy, who is a member of the bank's board, and I'm going to talk about the important role of our board of directors today, so I'm really glad to have Claire with us. And of course, last but not least, I'm really glad to have part of the team from our Toronto Regional Office joining me today. So, as Lara said, this is my first speech since joining the Bank of Canada, and the first in-person speech by a member of the Governing Council since the pandemic started. Coincidentally, the last in-person speech we made was also to Women in Capital Markets, so you were both our sort of going out and coming back event, so we're really pleased. And as I said, it just feels amazing to be gathering again, doesn't it? I probably, like many of you in the room, I gave more than my share of speeches over the last 2 years from my kitchen table to my laptop. You know, not the most engaging audience, not a really good feedback channel, so it's just really good to be in a room full of people. There's just something about being able to speak in person that makes it easier to connect, and it makes it easier to build trust and credibility too, and that's exactly what I want to talk about today. Trust and credibility. These are two things that are vitally important to central banks, and two things that the Bank of Canada works very hard to achieve. And it can be a bit tricky. A central bank isn't like a commercial bank where you can walk into a branch and open an account. We talk about things that can seem abstract to most people: growth, output, productivity. And our decisions take time, and they have to work their way through other parts of the economy before they directly affect Canadians. So we can seem a bit mysterious. And mysterious is not what we're aiming for. What we're aiming for is trust. We believe we earn the trust of Canadians by clearly explaining ourselves and by following through on our commitments. And we know that the better Canadians understand our goals, the more likely we are to achieve them. Public trust is therefore fundamental to our ability to deliver on our mandate. So we're acutely aware that with some of the extraordinary actions we've taken during the pandemic, and with inflation well above target, some people are questioning that trust. Tough questions, added scrutiny, and informed debate are entirely appropriate in the current environment. We welcome them. We see them as an opportunity to engage with Canadians about what we do, how we do it, and how we can improve. We also know that some Canadians are questioning whether their central bank is independent, whether it's accountable, and whether it's acting in their best interest. I'd like to respond directly to those questions today. Let me start with independence. We know this is important to Canadians. They tell us consistently through surveys, focus groups, and other consultations that they want their central bank to be independent of any commercial or political influence, and they want it to act clearly in their best interest. It may not be obvious why such independence matters, but it's vitally important. Central banks that provide public benefits, like low inflation, financial stability, and secure forms of payment, should not be influenced by commercial interests. And with respect to political influence, governments have many public policy priorities: health, education, industry, and trade, for example. And sometimes these policy pursuits can come into conflict with the central bank's core mandate of ensuring low and stable inflation. The desire to have a public entity separate from both the banking sector and the political process, whose job it is to guide the economy in the long-term best interest of its citizens, is what's behind the existence of central banks around the world. And it's what led to the creation of Canada's central bank in 1934. The Bank Act established the bank as a special type of Crown corporation with considerable independence to carry out its responsibilities. The Act prescribes our business and powers as they relate to our core responsibilities of monetary policy, financial stability, currency, funds management, and more recently, retail payments. But it also protects the bank's operational independence to carry out these activities free from political influence. Put differently, The Act dictates what we do, but not how we do it. And over the years, the bank has made important changes to how we achieve our mandate. The most important came in 1991, when we introduced our first inflation targeting agreement. This is exactly what it sounds like. It's a form of contract between the bank and the Government of Canada that sets out a target level of inflation and then gives the bank the decision-making authority day to day to achieve it. Canada was an early adopter of inflation targeting as an approach to improving monetary policy outcomes. Prior to the introduction of inflation targeting, the Bank of Canada and other central banks around the world experimented with a number of different ways to provide economic and price stability, like fixed exchange rates and controlling the supply of money. But a period of high and volatile inflation through the 1970s and the early 1980s prompted central bankers and economists around the world to search for a better approach. In Canada, for example, between 1974 and 1981, inflation started at 12%, dove down below 6%, and then shot back up to 12%. So after a considerable amount of research and reflection, the bank and the government of the day adopted their first inflation targeting agreement. We refer to the agreement now as our monetary policy framework, and the framework has been renewed at regular intervals ever since its introduction, and most recently, just last year, following an extensive public consultation. At each renewal, the government and the bank agree on the monetary policy objectives for Canada, and over the years there's been some adjustments to the agreement, but the fundamental principles have remained the same. And that's because it's worked. In the 30 years since the first agreement was signed, inflation has averaged almost exactly 2%. And as a result, Canadians' expectations have become firmly anchored on the inflation target. Our monetary policy framework is one way we put our independence into practice, but there are others. The bank has a board of directors made up of the governor, senior deputy governor, and 12 independent directors. The board doesn't make monetary policy decisions, but it provides important oversight to the bank's operations and finances. And the independent directors recommend the appointment of both the governor and the senior deputy governor for approval by cabinet. The bank also has financial independence. Our expenditures are funded through our own operations and not an appropriation from government, and our budget is approved by our board of directors. The bank's employees are subject to policies set by the bank and approved by our board, not federal public service agencies. And finally, the governor and I both serve fixed 7-year terms, providing a measure of continuity over economic cycles rather than electoral cycles, and allowing for decision-making that considers the long-term economic interests of Canadians. Taken together, these measures mean that the bank has the necessary room to act independently, to take a long-term view, and to make the decisions it judges in the best interest of Canadians. But this independence does not mean that we act without accountability. Like our independence, the bank's accountability is anchored in our governing legislation. The Bank of Canada Act requires that we're audited annually by 2 independent firms simultaneously. We're the only federal crown corporation with this requirement. The Act also provides the Minister of Finance the authority to enlarge the scope of these audits, to conduct special audits, and to request special reports. And Canada's Auditor General has the legal authority to investigate the bank's activities and records in relation to its role as fiscal agent for government and agent for the management of government debt. The Bank of Canada also makes it clear that if the Minister of Finance and the Bank of Canada Governor ever have a fundamental disagreement on a monetary policy action, the Minister has the power to direct the bank through a written directive tabled in Canada's Parliament. This is an important assurance of ultimate democratic accountability, and it is a testament to the bank's track record and to the respect that consecutive governments in Canada have shown for the central bank's independence that this power has never been exercised. The board is another important check and balance. They provide oversight to the bank's management and administration. They review corporate policies, plans, and our annual budget. As I mentioned earlier, the Governor and I both serve fixed terms for 7 years, meaning we're around long enough to be held accountable for our decisions. And we appear regularly before committees of the House of Commons and the Senate, where parliamentarians can and do question us on any of our functions and our decisions. And just as our monetary policy framework serves as the cornerstone to our independence, it also is the cornerstone to our accountability. The 2% target serves as a clear, very measurable objective. The Consumer Price Index, the CPI, is published monthly by Statistics Canada, so Canadians can easily track how we are performing against that objective. The bank also demonstrates accountability through our public communication. In 1995, shortly after our first inflation targeting agreement, we began publishing what we call the Monetary Policy Report, or MPR, that provides a detailed economic forecast twice a year. We now publish our MPR quarterly, and we have continually increased the amount of data and the level of detail that we make available to support the projections you'll find in our MPR. In 2000, we moved to 8 fixed dates for announcing our policy rate decision, and over the years, we've enhanced the amount of information that comes with each of these decisions. 4 of our policy rate decisions each year are accompanied by our MPR and followed by a press conference where the Governor and I explain how the forecast in the MPR affected our deliberations and our rate decision. The other 4 decisions are accompanied by a speech from a member of the Governing Council discussing our outlook and explaining our decision. And for all 8 decisions, of course, we publish a press release and take questions from the media. Beyond our policy announcements, the bank is always looking for ways to engage Canadians. My colleagues and I deliver about 20 public speeches each year across Canada discussing different aspects of the bank's work. And the bank speaks directly with individual Canadians and Canadian businesses about a wide variety of economic issues. We use their feedback as input to our policy deliberations, to enhance our research, and to improve our communication. Listening makes us better at our jobs and better at explaining our job in a way that makes sense to Canadians. So far, I've provided a bit of history and some important facts to explain how the bank's independence and accountability are embedded in legislation and then how they work in practice. What I want to do now is describe how the bank put its independence and accountability to work over the past 2 years to support Canadians through the pandemic. To do that, I'm going to go back in time to a little more than 2 years ago, around the time the bank was last here. The Canadian economy, indeed the global economy, had been suddenly shut down to deal with a health emergency. Nearly 6 million Canadians had lost their job or found themselves working less than half of their normal hours. Inflation fell sharply, dropping into negative territory. Financial markets froze. There was talk of another Great Depression, and it wasn't clear at that point how long this extraordinary situation would last, or indeed whether it might get worse. The Bank of Canada and central banks around the world intervened quickly, providing emergency liquidity to keep the financial system functioning so households and businesses could continue to access credit. This is one of the core functions of central banks, to restore stability in times of crisis and to provide liquidity when others won't. Governments around the world also intervened swiftly, providing immediate support to businesses that had to close and to people who had lost their income. The combined efforts of central banks and governments helped stabilize the economy and ensure that on top of an unparalleled health crisis, the world would not also have to stare down a financial crisis. But as the pandemic wore on, it became clear that the Canadian economy would need more support to recover from the initial shock and to avoid greater hardship for individuals and businesses. The bank had already lowered its policy rate as low as it could go to make borrowing less expensive for Canadian consumers and businesses and to stimulate the economy. So the bank committed to keeping the policy rate at 25 basis points until the economy had recovered. The bank also initiated quantitative easing, or QE, to complement a low policy rate. Through QE, the bank bought government bonds to push down long-term interest rates, those that matter most for household mortgages and business loans. All of these steps, lowering the policy rate, purchasing government bonds, and committing to keep rates low until the economy recovered, were done to support Canadians. They were not done to help commercial banks, and they were not done to fund government spending. They were done to lower the cost of borrowing for Canadians, to provide the economy with much-needed stimulus at a time when it was facing a once-in-generation downturn. Throughout this period of extraordinary policy action, the bank ramped up its approach to policy transparency and to clear communication. We explained our extraordinary actions as clearly as we could for Canadians. We talked about how they worked, what we expected their impact would be, and what the conditions to exit them would be. And we also talked about how to judge their effectiveness. We were transparent about our asset purchase programs, regularly reporting the holdings on our balance sheet. We set up a dedicated web page where the terms and conditions and the results of each purchase operation were made available. And once we ended our purchase programs, we published full transaction-level details. These steps were all designed to make sure the public could follow our actions and trust that we were doing what we said we would do. Maintaining public trust takes on a whole new imperative in a situation like the pandemic, when uncertainty is unusually high. The governor talked about this in a speech in the early days of the pandemic, how it was more important and yet at the same time more difficult for central banks to be trusted sources of information and analysis in times of crisis. Trust is often tested in a crisis, and there is no question that central banks have been tested by the unpredictability brought on by the pandemic. Our work relies on having a clear view of the future, so we can generate our outlook for the economy and for inflation. A clear view of the future has been really hard to come by for anyone this last 2 years, and there were definitely things we got wrong. The intensity and the persistence of supply chain disruptions has continued to surprise us. What started as a narrowly focused problem in a few key products has spread to a wide range of goods. The invasion of Ukraine has intensified supply chain problems and pushed up commodity prices and inflation worldwide. And now large parts of China are under a renewed lockdown, causing further supply issues, transportation backlogs, and adding to uncertainty. These are things we didn't foresee. And we know that we have a ways to go before Canadians can fully judge the success of what we've done. There's still work to do. The job is not complete, we know that. We will continue to focus on building and maintaining the trust of Canadians, and we know and expect Canadians will continue to hold us to account. Now, I'm going to wrap up by just saying a few words about where we are today and what Canadians can expect from us going forward. The good news is the economy has recovered remarkably fast. People are out, enjoying each other's company, and they're spending more. Business investment and exports are both picking up. Higher prices for the commodities that we export means more revenue coming into Canada. Job growth is strong, wage growth has returned to pre-pandemic levels, and the unemployment rate is at a record low. There are now almost twice as many vacant jobs as there were before the pandemic. That means wages are likely to increase as businesses compete for workers. The bad news is that Canadians are facing high inflation for the first time in more than 3 decades. With inflation running close to 7% and spreading to more and more everyday items, it's squeezing budgets for families and it's putting pressure on businesses. High inflation here in Canada and around the world results largely from global pressures such as supply chain disruptions and elevated commodity prices. But with the Canadian economy starting to overheat, we can't let demand get too far ahead of supply, or we risk adding further to inflation. This is why the bank has taken concrete and decisive action. We've raised our policy rate, and we've started the process of quantitative tightening, letting the bonds we've purchased over the course of the last 2 years mature and roll off our balance sheet. Interest rates remain low, but they are rising and they will need to rise higher still. These actions will moderate domestic demand so that a buildup in domestic prices doesn't add to the inflationary pressure in Canada that is coming from global factors. They will make borrowing costs more expensive, and we understand this has many Canadians worried. We'll be watching closely to see how the economy responds to higher interest rates. We're not on autopilot. We'll be looking for signs that the economy is returning to balance. Just as Canadians trusted us to respond with strength and conviction when the economy needed support at the onset of the pandemic, they are counting on us now to lower inflation. We take that trust seriously. We have the tools, we have the track record, and we are committed to getting inflation back to target. Let me stop here. You've been a great audience, super attentive, but of course, an important part of being accountable and transparent is taking questions and listening. So I'd be happy to do that now.
Thank you, Carolyn. I just am going to ask for the mic.
You're going to step in here if you...
Thank you for your remarks. And I understand that not everybody had a chance to write a question down on your cards. I'm going to kick off with the first question. We have another microphone, and we're very pleased to pass it around to the audience. So please, if you do have questions for the Deputy Senior Governor, please think of them on your toes, and we will get to you with a mic. Carolyn, I'm going to kick off with the first question. What would be your primary concern if Canada's governing power were to politicize the central bank? How would that impact trust?
Well, I mean, as I said at the very outset of the speech, public trust is fundamental to our ability to do our job, and anything that damages that trust ultimately damages our ability to deliver for Canadians. It ultimately hurts Canadians. I think that's a pretty well-accepted fact in Canada and by most politicians, and so it's unusual for the bank to get dragged into the political rhetoric. It's not unheard of, but it's fairly unusual, particularly in developed economies. But I would say also, and this is an important part of the speech I hope came through too, accountability is the flip side of independence. They go hand in hand, they go together. And it is entirely appropriate that Canadians are asking tough questions of us right now. Inflation is too high. It's well above our target. It's hurting Canadians. They need to be asking us questions, and we need to keep answering them. We know that. And ultimately, we know that the most important thing we can do to preserve the trust of Canadians is to get inflation back down to target. That's something we're determined to do.
No, that's an excellent point. And, you know, I think for Canadians, the ability to understand, you know, where there will be some relief in upward pressure on prices is really important. The certainty for financial markets is very important. It's important globally, but it's certainly very important in Canada. So, you know, I think all of those points are very important. The other question, you know, I have relates to your board. And, you know, I assume your board obviously meets quarterly. Do they meet more often than that?
Well, at least quarterly, yeah. I mean, I think they're probably like a lot of boards over the last 2 years. The schedule's been a bit disrupted, but they do meet regularly, yeah.
And what do you think is unique about the composition of your board and the advice that the board does provide to the bank on a regular basis?
Yeah, well, I mean, our board is really valuable for a couple of reasons. One, I mean, as I said, a really important part of our job is to have our finger on the pulse of the Canadian economy And our board, we have a diverse board from across Canada. They're in different businesses and different communities across Canada. And so they're a really, really valuable source of information to us as we think about policy decisions and communication, how to make sure Canadians can understand what we're doing. And then they provide the sort of more traditional functions that a board would provide. As I said, they approve our budgets, our policies. You know, right now we're going through the exercise I'm sure everybody in the room is going through about thinking about how is our workforce going to change as we go back to the office, at least part-time. How do we maintain the talent that we need in this market? And those are the kinds of things our board provides really solid advice for us on.
WCM is working on a hybrid work report right now. We were talking about it at our table, and we're really looking forward to releasing that in the coming weeks for our sponsor community.
We do have questions. I thought maybe everybody was out of practice and wouldn't have any questions.
Patty, I'll let you go first.
Just looking around the room. Hi, Patty Shugart, RBC Capital Markets, also chair of the Advisory Council for WCM. Welcome, thank you. I just look around the room and I see a lot of young people, and I think about what you've got to do to bring inflation under control, and at the same time we know rates are going up, and we think about affordable housing, we think about foreign investment and trying to control, like, how do you think about that in the context of your day-to-day decisions and the policies that you and the governor
Yeah, I mean, I think that's, I noticed that too. It is so great to see so many young people in the room, particularly at a Women in Capital Markets event. It does my heart good. So, you know, I think what you're talking about is what we call distributional impacts of monetary policy, how it affects different parts of the economy, different segments of the population differently. This is something we spend a lot of time thinking about, actually. One of my colleagues, Sharon Kazicki, gave a speech exactly on this topic not long ago. It's a great speech. It gives a good sort of outline of the bank's work on this. But, I mean, you make an important point, and I think, Larry, you said this in your opening remarks. We have a generation of people, of business leaders even, who haven't lived through high inflation. We have a 30-year track record of keeping inflation low. You know, the good news, I think, is that Canadians are sharp. They understand the inflation environment in Canada. They know that it's coming from a lot of global pressures. They understand that. You know, so, you know, what we're focused on is making sure that we don't add to those global pressures, you know, with the buildup of prices in Canada. We do expect, you know, I said earlier that the supply chains have surprised us a bit. We thought they'd abate sooner. They will eventually go. Commodities will stabilize, and that will naturally bring inflation down, provided we keep expectations anchored. That's the important part of why we need to act now. We need to get rates up, dampen demand in Canada, and bring it down. Yep.
Another question from the audience.
Hi,
thank you for your speech. It was excellent. Earl Davis, BMO Global Asset Management. You mentioned both demand getting ahead of itself a little bit, as well as the tight labor markets. From a central banker's consideration, do you focus more on the growth and the demand for goods, or employment and that wage inflation? How do you best target getting inflation down?
So, I mean, what we're focused on now is getting inflation down. So, you know, we look at both. The labor market is a really strong indicator right now of the excess demand in the Canadian economy. So, you know, I guess the way we think about it is, you know, this has been a difficult period to forecast because we've had both supply constraints and now we have demand pressures. So, I mean, the labor market is certainly a key indicator that we look at, but in this environment, we're needing to look at both the sort of demand and supply side. Yeah.
Carolyn, can you talk about the trend of core inflation and the most important components for the bank at this moment to monitor?
The most important components, well, I mean, we monitor all of the components of core inflation. Certainly we look at, you know, the things that Canadians are feeling most right now are energy. Certainly housing is a key area. But really, at the end of the day, what we look at is the number, is the level of inflation, and I mean, that's what we target. We don't sort of go in and target components of inflation. We target the overall level of inflation in the economy.
We have another question from the audience.
Helena, I knew you'd ask me a question.
Okay. I couldn't disappoint you, Carol. So, you joined the bank at such a critical point of an economic regime change, because we just not long ago worried about deflation and unemployment and the economy, and now we again worry about, but almost on the opposite mirror image of what is happening, while certain forces like even the pandemic are still with us. So I was just wondering, from your global perspective of what you see, if another shock hits, could we expect central banks again to coordinate swiftly? I'm almost seeing now a systems response. Great financial crises took a few months, but the central banks massively injected liquidity. In the context of pandemic, it happened even faster. So is this now something we are to expect?
Yeah, thanks for that question, Lena. You know, we've been getting a lot of questions lately, particularly after the invasion of Ukraine, about the functioning of international groups and international coordination. And I know some are pessimistic that these organizations can work in this environment, but I guess what I would say, having just left, spending 3 years in this environment, these are people who care deeply about their jobs. They have really benefited a lot. I mean, you talked about the financial crisis. I think we learned a lot that global coordination, sharing information, benefits policy action. There is no doubt that the geopolitical environment now is more fraught. It's more difficult. You saw, if you were reading some of the headlines that came out of the IMF meetings last week, you could see that. But I used to get this question a lot about the Basel Committee, and sort of they would ask us how we were dealing with the Trump era or this or that, and I would say, I really hate to disappoint you, but we are very sort of head down, technical people. We're not political people. Those things don't play out. Obviously, something on the scale of war in Europe, that's going to affect geopolitical coordination for sure. But I think it'll stay strong. I think it has to stay strong. I mean, just when it's most difficult is usually when you need it most.
Is the Bank of Canada concerned about causing a recession in its efforts to reduce inflation caused largely by supply-driven effects?
Yeah, I mean, our outlook is laid out really clearly in our last monetary policy report. What we're expecting is growth in the economy, quite strong growth actually. We expect it to moderate. We expect demand and supply to come back into balance, and we expect inflation to come down gradually. It's true, a big part of the inflation in the Canadian economy right now is coming from global factors, and as I said, we've been surprised by how persistent some of those factors are, but we do expect they're going to abate eventually, and as I said, provided we keep expectations anchored, we do think inflation will come down gradually.
Given Canada's large housing sector, what is the likelihood that the hiking cycle will pause it?
So let me say a few things about housing. This is, I'm glad to see my 3 years away from Canada, we didn't lose our preoccupation with the housing sector. So the first thing I would say, and a really important point, is we don't set monetary policy for the housing market. We don't set it for any particular segment of the economy. We set it for the economy as a whole. Now, we know that rising rates are going to put pressure on borrowers, and in particular on people who have stretched their borrowing capacity to get into the housing market. But inflation is putting pressure on all Canadians. So we need We need higher rates to moderate demand, including demand in the housing market. The third thing I'd say is, housing prices have been elevated for a while. Housing activity has been elevated for a while. It was elevated before the pandemic. Certainly, factors in the pandemic contributed to an even stronger growth in prices. But again, we're already seeing as rates start to increase, as monetary policy normalizes, we're seeing that come off a bit. Housing price growth is unsustainably strong in Canada. It would not be a bad thing for the economy for the growth in housing prices to moderate a bit, and we do expect that'll happen as rates go up. It needs to happen.
What work or research is the Bank of Canada doing on central bank digital currencies?
Yeah. So, our work on central bank digital currencies is guided by the same thing all our work is guided by, and that is the public interest. We think that there is potential benefits to be had for Canadians in a central bank digital currency. The economy is, more increasingly driven by digital transactions. This was another one of those trends that the pandemic accelerated. We were all shopping online from home. So increasingly, Canadians want digital forms of payment. And right now, the only forms of digital payment they have access to are private ones, private cryptocurrencies, that are largely or totally unregulated. And in Canada, we are used to a very well-regulated financial sector. We are used to not having to worry about money that we put in a financial institution or in a payment service provider being there when we want it. And that's a completely reasonable expectation. It's one we want to preserve in Canada. But you don't have that right now in the digital currencies that are available to Canada. As I said, the cryptocurrencies that are out there are largely unregulated. We think that needs to change. It will change. Eventually, for cryptocurrencies to really realize their potential and to have wider adoption, they'll need to meet some basic regulatory standards. We also think that the potential, the technology that underlines digital currencies has some potential. Can make payments more secure, cheaper, faster, particularly when you're making payments across borders. And so we think it's completely realistic that Canadians are going to want a digital Canadian dollar at some point. Ultimately, and this is really important, ultimately, the decision about whether Canada will have a digital central bank digital currency has to be made in Parliament. So the business powers that I mentioned in the speech that are given to the Bank of Canada don't include the ability right now to issue a digital currency. So ultimately, the Government of Canada, the Parliament, on behalf of Canadians, will make the decision about whether we have one or not. In the meantime, our job is to do the research and the development to make that option available so that Canadians have the freedom to choose it.
How do you see the latest comprehensive economic partnership signed with other countries impact everyday business and perhaps inflation? What is the time lag to see the impact of these agreements?
So the economic partnership agreements. Well, I mean, in general, Canada's a small, open economy, and we have relied on trade for a long time to increase our standard of living. Trade has benefited Canadians over the years, and it's actually also been a big contributor to keeping prices low and stable. So trade in general is something we support. We think in an economy like Canada, trade's important. It's going to be challenging in the next few years. As I said earlier, the pandemic itself, the war in Ukraine, they've dealt a bit of a blow to trading relationships. Countries are retreating a bit. That's probably natural. We hope it's temporary. A large retreat into trade barriers would look a lot, like deglobalization, and probably, it wouldn't benefit the Canadian economy. So we do hope we'll continue to see trade.
Thank you very much, Senior Deputy Governor. You gave us a lot of very insightful pieces of wisdom today. You know, trust is absolutely tested in times of crisis. And, you know, giving us your time and explaining in great detail the importance of trust and credibility for the central bank was fantastic. So we're very grateful to have you here today. Thank you.
It's been my pleasure. Thanks.